So Logan's going to start with multiple questions from the YouTube community that he has a following for, and then we'll open it up to everyone to go from there. Just ask that you guys stay muted, and then you can raise your hand in the chat or shoot me. You can message a chat, and then we can answer questions through there, or you could just unmute your mic if there's a pause and ask your question, and I'll rattle off an answer. So Logan, take it away.
Yeah, so I have a couple questions I want to touch on first. So I have about five, if that's cool if I go through those. They seem to be pretty
Yeah, sure.
quickly. So the first one is, what would make you not want to trade spreads for the week?
Yeah, so that's a good question. I'll steer your guys' attention right here to the VIX. Trading with the VIX above 25 for me is kind of a dead deal for me, mainly because when I'm trading these spreads, they're non-directional. So that basically means that the stock can go up or down. But if the VIX is usually above 25, that usually means that there's implied volatility in the market, and that's going to make it a directional kind of deal. So that's going to take away runway. That's what I like to refer it to as. So that's usually a big deal breaker for me if the VIX is above 25. So if the VIX is above 25, I usually don't trade that week, or I take very small positions, depending on investor goals. If they obviously would still want to see growth in their account. The other thing is when you set up these spreads, they give you a readout of your credit to collateral. If you have to put up $2,000 to make $10, I don't want to take that deal. I would take 2,000 to make 100, but usually I don't want to do anything lesser than that ratio right there. And then you can scale that up depending on how much collateral you want. So you have to think, is that collateral worth the little sum of trading at such a high probability? That's something that you have to think about as an investor.
100%. The next question. So let's say you're already in spreads and you're observing the VIX and it pops later in the week. What is kind of your like VIX target price or like action for you to say, all right, guys, so like if it's a Wednesday, right, and the VIX pops maybe like $8 overnight, and everything's still looking smooth, but we're getting closer to strike prices, right? Kind of
Right.
what is your, like, is there a certain number on the VIX or a certain thing that you look for at that point when we're like halfway through the week?
Right. Yeah. If you're halfway through the week, that means your position's already in. The first thing I'm going to be looking at is I'm going to be looking at the mark of the index that we're trading. An example of mark would be currently the TQQ just closed at 180, 180. So the mark would be 180, 180. So then if my spread that I sold like a 174. Well, in that case, then like the mark's going to be, 7. So, or the runway is going to be 7 between the 181 and 174. So that's the first thing I look at. If I still have a runway greater than 5, but a spread that's not is in a loss due to implied volatility rise, which is if the VIX were to rise, implied volatility will rise. So if I have a runway of 5, that's good. I feel safe. Anytime you get less than 5, like around 2 or 3, you're going to start to see some significant loss because then the deltas are going to be increasing on you. So you definitely want to look at your delta. I like making adjustments to spreads around the delta of 25, 0.25, because deltas go from 0 to 1, or 0 to 1. So look at those. The other thing is you obviously want to look at the VIX is a good target to tell you what implied volatility could do at the end of the week. But the biggest thing is that I just mainly focus on the actual mark of the underlining and compare to where I took it, the spread at. So that's the runway.
Got you. Okay. Yeah, no, that's perfect. For the third one, when doing spreads, why do you choose to do 5 strikes or more wide? Is it to protect the collateral if the short leg goes in the money? That's the
5 or wide. So 5 or wide is what I've been doing. I think 5 wide is the sweet spot, I think, for credit to collateral ratio for what I've been trading on my account.
Okay.
The big thing that everyone should know is that you can take the trades that I can call out in the Discord. As long as you sell the same strike price that I sold, you still have the same probability to win. Now, by me making a spread 5 wide, that usually means I'm taking like 40 contracts. that's usually about a $2,000 position on average. So
Hmm.
that's just how you scale up the strategy, especially as your account continues to compound weekly. So the five wide, that's not a it's the width of your spread is completely up to investor discretion based off of how much buying power you have in your account.
Perfect. The fourth one, when monitoring your runway, when do you start to worry or wait for the short leg to go in the money, or do you only close a position once it goes in the money?
Yeah, so I'll usually close a position if I'm one away, like runway's less than one, or I'm in the money, and the premiums or the premiums on the position are higher about 25%. So the spread has increased in price about 25%.
Hmm.
That's when I would usually do a manual close, and I've only done a manual close back in March when there's the after the V shape, there was that drop off.
Hmm.
That was a pretty stressful week for most traders. So the spreads did not work out that week, mainly just off the fact of the implied volatility at that week, which was around here actually.
Hmm.
It was greater than the VIX shot up. So I hit 45 midweek. So that was a rough week.
Yeah, right there, definitely, as the premium prices increases.
Yep.
And
So
then the
yeah,
oh yeah,
and everyone's alert. Everyone would be alerted of a manual close. Obviously, you don't want to do a manual close,
hmm
but yeah, manually closing the put side is not a very good situation to be in.
no, I agree. It's a lot harder to get it to fill because there's just so much, especially if the
Yeah,
IVs are pumping,
the
right?
best way to get out of the spreads is using market orders, and that's something you can't do on Robinhood. So that's why I use ThinkorSwim to
Hmm.
protect the collateral that I have remaining, so I can get out as quick as possible.
Perfect. And the fifth and final one, so it says, when doing your spreads, do you leave any money on the sideline in case one goes against you and you can close it for a small loss? If you can get out a number of what percent of your account you should leave on the sidelines just in case every week.
So when I'm doing spreads, it's I usually go 95% into the buying power and
Mm-hmm.
usually leave like anywhere from like $200 to like $40 left. I'm kind of all in. The biggest thing is that I won't take calls until I can diversify the number of positions that I'm in. Taking calls on for Thursday is the most risky because the stock could all of a sudden just shoot up randomly.
Mm-hmm.
So you just got to make sure you're keeping tabs on the calls. Sometimes you might have to close out a call position, but you use a profitable put position to close out the calls. So you take the calls and I'm able to diversify across multiple positions. I recommend more than usually a minimum of two if you're gonna have to have two positions open to take calls on Thursday. So a lot of early investors that I'm working with, they usually are only able to take they're only able to afford one put position. So I don't usually take calls on those positions because messing up the call side could wipe out all the growth in the account.
Mm-hmm. Messing up on the call side.
That's right. Yeah.
Perfect.
So the biggest thing is monitor. And when you take the calls, you have to monitor runway on the call side, but also monitor the where the underlining is in regards to the puts as well.
Mm-hmm.
So it becomes once you take the calls, you make an iron condor. So obviously you need your underlying to stay above your put short strike and below your call short strike. So
Mm-hmm.
it becomes a little more difficult and tedious management. But that's why I use some automated order systems that I've coded into ThinkorSwim and whatnot to help me out with that.
Definitely.
But yeah, usually I haven't taken calls lately, mainly because the premiums have been so little
Yep.
for the like risking 4,000 to make 100. That's not going to work for me. So
Mm-hmm.
I haven't been doing that lately.
Definitely, because it's definitely a lot easier, like you said, to just have your put spreads from Monday that are already probably near 100% going into
Right.
Thursday
Yeah,
at
I would much
close.
rather take that. So yeah, if you have your puts at 100% already and you're going to take calls, well, if
Hmm.
your calls mess up, you're going to take about 65% off your profitable position. So you'd be only making about 35% return on that one position
Hmm.
and probably less than 3% capital wise on the account.
That week, which is just tough on a full
Yeah.
week.
One thing to take notice of is that when you take positions, in thinkorswim it will say your profit loss percentage is a certain number like
Hmm.
90%, 100%. That's talking about your option premium. But when I talk about like a 7.5% return on the week, I'm talking about the actual account value. So that's just something to keep in mind.
Definitely. Well, that's perfect. I mean, those are my 5 questions that I had. And towards the end, if we do have extra time, I just want other people to be able to get some questions in if you have any. But I also have a couple more if nobody's ready. But
Oh, wait, so we got one here.
cool.
Let's see what we got here from Sam. He says, "Any suggestions as to which moving averages to follow for 5 to 7 days to expiration?" So Sam, the nice thing about spreads is that I don't look at moving averages. I don't look at technical indicators. The only thing I ever look at is the option chain. Let me I can pull up an example here. This is the great thing about spreads. Spreads are non-directional, which I love. So right now, obviously, I can't look at it. Can't look at obviously day 0 days till expiration. So this just expired. But if you look at January 8th, the biggest thing you want to look at is when you're taking spreads. We're talking probabilities. So right here is the implied expected move right now is for the TQQs, which is ProShares Trust Ultra Pro QQQ ETF. This thing is QQQ plus another like 50 cents on every option. It's insane. It's expected to move for the expiration of January 8th, which is next Friday. It's expected to move at that time plus or minus 14,485. So it could be anywhere from like 165 to about 100 or 205. So it's somewhere in that range. This number is about 68% accurate based off of bell curves and whatnot.
Mm-hmm.
So basically you just record when you take these spreads, you start where it's kind of like that. Let's use 180, 180 for example. So you're right down here. You're in your probability of the money. You obviously when you're at the money or it almost close, but it's also about 50%. So you have about 50% chance to win. That's when when you're taking like naked options, when you're using moving averages and whatnot.
Mm-hmm.
You usually have anywhere from a 30% to a 50% chance to win. And that's not very good odds, I would say. Some people might argue against that. I would rather trade the QQQ. I mean, these numbers are going to be way outdated because the market just closed. But
Mm-hmm.
180.15, you're subtracting about 14, so you're looking around 165. That's already giving you about 78% chance to win. And then you could even be more safe. You could take it at 86% chance to win. Your runway right now, even though these quotes are going to be outdated because the market just closed.
Mm-hmm.
I mean, that runway right there is insane. That's about 29 or 30. So that's the type of trading that I'm doing. High probability spread trading, putting up a decent amount of money to make a certain amount of money weekly that
Mm-hmm.
compounds over time. And that's the main thing. We're taking advantage of compounding interest, or in this case, just compounding equity. Anywhere from hopefully 7.5 to 10% a week. That's something that the interest like in bank accounts and whatnot can't even come close to.
Oh, yeah,
So
that's literally
that's what we're
insane.
talking about. No technical indicators needed, just some subtraction and a lot of reporting and journaling. That's mainly what's powering the system.
Yeah, I've been
You don't
taking
have to
some notes.
complicate it with coding or anything like that. I have, but you can start out very basic and just subtract the spot price from the expected move, see where that's at. If you like it, take it. If not, then bump it up to about 86 to 90% and just go from there.
Mm-hmm.
And it's always paper trade. So that's what I got for you, Sam.
That's perfect. Sam said, "Gotcha,
See what else we
thanks."
got here.
Perfect.
So Jim. Jim said, "Can you talk a little more about your exit strategy if the spread is in the danger zone? When would you actually close out, and what would that cost you?" Yeah. So when you're in the danger zone, um, when you're in the danger zone, that's like when your runway is less than one or whatnot. The biggest thing is usually in that case, you ideally just want to get the position off the table. I hopefully it might be the case where it's a single option. In that case, you're going to take a loss. If you have multiple other positions open, that the growth on those positions can counteract that loss, and you could still potentially finish the week in green. But again, the biggest thing is you want to either think about your deltas, which is delta's right here. So usually I take about an 86% chance to win. That's a delta of 0.9 to 0.12, and I'll usually exit a position if delta rises to about 0.25. So that's usually when I'm getting out. Negative. Notice that this is puts, so the delta is going to be negative because you're selling, or because they're puts, which is where you have the option to exercise 100 shares and whatnot. So that's that's what I'm mainly looking at, is that the deltas are rising, and then I'm obviously, you also can look at the actual pricing of this of the options, which is, right here, your bid and ask. If that bid and ask is quite wide, or if it's quite high, then obviously the premiums are rising and whatnot. So then I'm thinking, all right, I ideally want to get out just at a 25% loss. If I can't get out, then I'm just going to take it out in the market order and fight another day.
It's
So
fantastic.
the other good point to notice about that is, a lot of people say, oh, spreading trades is not going to make you money over time. Trading spreads will make you money over time. You just have to cap your losses quick. Because if you take a 100% loss on a spread, well, now, yeah, if you think about it, if I'm trading at a 90% clip, 100 trades, there's 9 trades, or yeah, there'll be 90 trades that will win and 10%, 10 that will lose. But that 10 that lose, yes, that loss could be greater. But if I cap that loss instead of 100% at 25%, then I will make money over time. So you have to, the biggest thing about trading spreads is knowing how to take your high probability chances and knowing when to exit. And the biggest thing to exit is, if you're uncomfortable with the loss, then just get out and fight another day. Can you explain why you trade weeklies versus longer expirations? Yeah, I trade weeklies mainly from the fact that I would rather, when I'm thinking about directional and non-directional, I think I have a higher probability of knowing that, yeah, the TQQ is not going to hit 157 next week. Then potentially in 2 weeks, it could potentially actually hit 157. Now, yes, I know the option premiums are a lot higher on the TQQ, with that being the case, but that's just something that I'm more comfortable with, being able to statistically model forward an option, or a underlying for 1 week rather than 2 weeks or for 3 weeks. But I am exploring calendar spreads, and those are 3 week, about 56 days to expert. So that's something that will be coming soon, hopefully, to the Discord users as well. New strategy and a new spread strategy.
Yeah, that'd be fantastic. I've actually started to hear about those a little bit as of recent, and I was curious to see what your perspective was on it.
Yeah, right now I'm still fooling around with them on paper trading, which I
Hmm.
recommend to everybody. Take just experience. I ThinkorSwim has the ability to open up as many paper trading accounts as you want. So just, yeah, I'm just fooling around with them. I'm looking at equity ones as well as ETF ones.
Hmm.
The biggest thing is understanding the profitability zone of them. So it's a little more complicated than these spreads. These spreads are pretty straightforward. The profit loss diagram, that is.
Hmm.
So yeah, calendar spreads, once I narrow it in and get it going, they will be heading to the community as soon as possible. William said, would you recommend trade spreads under $2,000, say $1,000, for instance? If so, which type of spreads would be ideal for a smaller account balance? So to start, you're going to want $2,000 minimum, because that's what you need to have for a ThinkorSwim margin account. I obviously, to trade spreads, ThinkorSwim requires margin in case you have to borrow to close. So that's what they do. Trading spreads of 1,000 is rough. I mean, we're talking like $15 at a time. It's not necessarily your best bet, I think. I like to say that a minimum balance of 2 is pretty good for spreads. I'm seeing a lot of people trading spreads between 3.5 and 4.5K. So it comes back to the old saying that it takes money to make money. I recommend doing as much education on your own as you can to try to grow your account to the point where you can take spreads. Because once you get to 10K account size, you're usually seeing about a $1,000 week returns in the account, which is phenomenal. So it just explodes from there, which is what happened to my account. So we got a couple more coming in. You mentioned, Edgar said, you mentioned the beginner level. How do you get to that level? Is there an efficiency change once you get into coding and so on? So the coding was just simple stuff. Well, I guess it's not necessarily simple to understand someone who might not understand financial coding, but it's just a system that alerts me that, hey, the deltas are increasing on this option and whatnot. So that's just something to be wary of. It's all stuff that can be done manually. It's not anything that needs to be done that's crazy hard or anything like that. But it's also not something that a beginner wants to focus on. As a beginner, you want to focus on identifying what a good spread is, where a good spread is found on the option chain, aka 86 to 90% probability out of the money, which is what this column is right here. So that's the kind of stuff you want to focus on, and then just focus on paper trading. That's the best advice I can give. Paper trading. Just make sure to tell people that it is paper trading and go from there. Let's see. Was there another one? Yeah, paper trading in the meantime. Absolutely. Yeah, and you mentioned that you never close a position manually. Could you demonstrate how to set it up automatically on ThinkorSwim? Um, so I will close manually. I close manually using market orders. But I could show you. Could potentially show. Well, actually, I think the market. And I should. It should be able to work. Let's see. We'll check it out. We'll find out here. So when you're on an option here, basically what's happening here is I'm selling an 86.45% chance on the 157 on the TQQ. So you go sell vertical. So here we go. iPhone in here. All right, cool. So we got about 10 contracts selling the vertical. We're selling a 157, buying a 156.5. That's only 7-cent credit. So let's just for fun, giggles, watch. I mean, you could see how much credit you can actually make. Well, the market's closed, so the credit values aren't right. A 157, 150 should make you about 30 cents or $30 per spread on a TQQ. So one thing you want to do when you do, if you want to, I have this automatically done for me, but if you want to do it manually, what you do here is you have this position, right? Then you're going to want to create an opposite order. Yeah, so you want to create two opposite orders here. Wait, here we go. So yeah, you go first trigs OCO. Then we're going to want to create an opposite order. And then we're going to want to create an opposite order. And you want the second order here, this order, I'm just going to switch it. You want both other orders to be green. And now, then you want to make your link trig, TRG. That means a trigger. And now, obviously, what we're happened here is that we are selling. I gotta let me find a number that I can actually like show. 157. Yeah, the credit. With the market closed, the credit's not working out here. Let me just do it with 20. All right. So we're selling a 157, 154 for 20 cents. Pretty good. So now what we have here is these two trigs. Now a first trigs other cancels other. So what's going to happen is that these triggers are going to occur, and then I just got to change this back to a 154 now at $20 a spread because there's a $100 multiplier, which is on it's showing on right here on the expiration. So 20 times 0.20 times 100 is 20. So each spread I'm selling 10 of is worth about $20. So this whole position is a $200 position. So here's this credit limit. When I'm thinking about where I want to take it off the table, basically that let's see percentage. Basically, what would happen is that it would be a minus. It would lose about 95% of its. It would lose about 95% of its credit, and that basically is a max profit and minus commissions and all that on a manual close here. So that right there, this will be your take profit order. And notice how it's green. It's a debit. So when you sell credit, you receive the money, and then when you close it, you give some money back, but it's lesser than the money you initially received in your account. So that's how the profit shows. Now, to get out in a loss, the spread you sold for 20, it might go up to 25, or it might go up to $28 spread. In that case, you lost $8 times 10 contracts or 10 spreads, so you lost about $80. So I like to usually say that if the option price were to increase by 125%, which means that the spread is worth, in this case, $125, a 25% gain on the spread value, that right there would show you that, all right, now I'm going to be able to get out if the spread value were to increase by 25%. Mm-hmm. So these are automatically coded in my positions, but this is how you would manually input into the positions. So again, just to recap, advanced order, first trigs OCO, your red is your credit spread. These greens are this one with a minus -5% debit. That is a stop. That is a take profit order. And this plus 125, this is your stop loss. kind of confusing to some people who usually trade, but this is how you do it. And then make sure your link is trig, and make sure there's 2 green and 1 red.
Mm-hmm.
And that is how you set up the stop loss and the take profit. Do you have to pay commissions on those two TRGs? Yeah, you would only pay commission on the first one that takes an order. So as soon as the stop loss were to hit, the take profit order is canceled, and that's all done by ThinkorSwim. So you only pay the 65 cents times 10, so $6.50 on the order to close. And ThinkorSwim cancels the other orders. Anything else, guys?
Yeah, Jim said, I think you touched on this a little bit, but is it possible to close out your sell and keep your buy open to maximize profit? If so, can you walk through how to do that?
So I can't walk through it because I don't have any positions open right now. I only have shares open on this account.
Mm-hmm.
Basically, though, in order for you to close I think he's basically saying close the put side first. You have to have that collateral in the account. So you would need the collateral that you took on the puts has to be in the account.
Mm-hmm.
So to do that first, you have to have a pretty good sized account, and you have to leave a good amount of money on the table. So that's why usually you close the puts. If the puts are doing well and the calls end up doing bad, then you can close the puts first to get your money, get your collateral back from the puts, and then you put up that collateral money to close the calls, which has to be a debit, which is a pretty high incurring debit, and that's where you incur a loss on that call side, but your put side is still profitable.
Mm-hmm.
So yeah, usually you have to close your winning first to close the losing side next, and do it all in the market order so you can get out right away. Otherwise, you just have to have you have to have the collateral in your account to close the put side
And
before the call side.
That's the one thing I noticed with Robinhood too, right? Since it's limit orders and not market, that it's nearly impossible to do that.
Yeah. And Robinhood, if you're stuck in the money on spread, you're in trouble.
Mm-hmm.
And that's why I don't trust it. I stopped using it.
Mm-hmm.
Only thing I use Robinhood for is some long option calls, just to take it and just to continue to learn long options, because that's something I still struggle with. I've only been successful a couple of times.
For sure. Perfect. I got a couple questions too, if there's no more.
Let's see here. One more question. I know you mentioned you recommend buying the spreads before 11 a.m. What is the reason behind that? I usually see the option premiums decrease after 11 a.m. on the chain. So when I say the chain, you have your bid ask here, and then you have mark. So the mark is what I'm calling the premium. So at like 169, so 169 right here, the premium is $2.97. So if you were to sell that spread, here, I'll just do it for you. Let's sell, go into here, for example, let's not do it that way. Let's sell vertical on a 169, and we'll do like a 169, 160. You'll see how much this is actually worth. Sell vertical. There you go. So that is $134 a spread. That's $1,340 position.
Mm-hmm.
Probably in collateral, probably around 30,000. But yeah, you could see here 2,970, because you're getting you're getting $297 on the 169s,
Mm-hmm.
and then you're selling that, you're receiving that, and then you're buying a 160, you're buying a $163. So the 297 minus the 163 gets you a 134, and that's what that 1.34 is. So that's the premium. So usually you just want to see a good amount of premium on the options and whatnot. But I usually see a decrease after 11, and I usually try to take my trades between 9:30 and 9:45 in the morning, EST, Eastern Standard Time. How do you calculate the expected move? That might be an entire video all in itself. Biggest thing, Jan, is, you just take ThinkorSwim calculates it for you, the plus or minus 14,485, but I can calculate it for any duration. But the biggest thing is just take ThinkorSwim's number. They calculate it for you depending on what option chain you choose. So for example, 8th of January, plus or minus 14. If we jump down here 22 days, now they're saying plus or minus 26. So there's a lot of the change in the implied volatility and the extra days of expiration they're thinking that the thinker TQQ can go even higher or even lower. So that's makes it interesting, right? Because then if you trade where I was trading on the 8th of January, where I was trading around what I said I wanted to trade around like where was I? Yeah, like right down here, like a 157. If I took that same trade with 22 days expiration, I'm actually inside of the expected move, and that would be dangerous. So you want to make sure you're outside of the expected move when you trade, because the difference of 181 minus 14 is like in this area, but I'm up here. And you could see that because this area here is like 70% chance to win, and now I'm talking 86 to 90%. So easiest thing for yourself, if you want to do the math, just think 86 to 90% probability out of the money. To add probability out of the money onto your option chain, just go to your layout, customize, type prob, it's right here. Probability out of the money, and then you just hit add item. I already did it, so I'm not going to do it. I think you mentioned and told them to set up a specific risk management strategy for your account. Yeah, so talking about the risk management strategy, that's just asking yourself how big of a loss do you want to take? What are you comfortable with? That's all stuff that you have to talk to yourself about, really. I say I'm not comfortable with a 25% gain on my spreads. That's what I said for myself, and then investors have different ones too. They have to follow. What key variables do you track? Oh yeah, absolutely. So I track the when you go on ThinkorSwim mobile, you have the open, the close, the range, which is the difference between the highest point and the lowest point during the week, and then I track the expected move for the upcoming week.
All right, so this is one from YouTube that says, "What does Maz mean by using the TQQ to cover the standard SPY trade and close SPY at 50%? It sounds like over leveraging and play another product to hedge slash gain to hit the weekly goals and closing out SPY if it goes wrong."
Whoever wrote that question answered their own question with their reasoning. It's absolutely, the TQQ has a lot higher leverage. It's about 3x. It's a 3x ETF.
Mhm.
So the marks on the TQQ at the 86% are around like 1.245. Now they're not updated because the market closed, but I usually see that the TQQ has some insane premium around the 86 to 90% area. So, but compared to the SPY usually only has about like 40 cents, and then you subtract, and you usually only it depends each week. But the TQQ, if you take the TQQ, sometimes I take it, sometimes I don't. The TQQ can be used, or it also could be a deadly weapon if it falls off the sky, which it has happened to me before.
Mhm.
The TQQ can be used as a tool to get a much higher gain on your put spreads. And then if something goes wrong on SPY, you could close your TQQ, and then you can close SPY, and the TQQ can weigh out the SPY, and you could still close the week out with a gain. So that's some position management. Once you're doing some paper trading and whatnot, position management is something that I can help anybody with in the Discord to understand.
Fantastic.
Any other? We got one last question here. Looks like Jan's gonna go for it. What ETF SPY did QQQ have been more successful in this approach? Yeah, so the ETFs that I trade, honestly, the TQQ has the highest gain in the account. The QQQ is followed next, then the SPY, then IWM, then the DIA. So the DIA, the Dow Jones, that usually has the least amount of premium, but it's usually a consistent mover. So it doesn't have those big spikes. TQQ, a lot of premium, some spiking. So you have to be careful. The SPY is like the best, I think. It has good premium, good movement, not a lot of spiking, a good amount of range, a good amount of volume. I can easily get in and out. I like the SPY. So I usually trade SPY, IWM, QQQ, TQQ, DIA, and then I also will trade XBI, which is a biotech, and I will also trade SMH, which is the semiconductor ETF, which
Mhm.
is a really good one as well. Not as much as the other ones, but that one's a consistent winner. And I haven't taken as many trades on that one, but usually I start with those five, and then if the SPY or the DIA 1 week doesn't have enough premium, I'll look at the SMH or I'll look at XBI, and go from there. But if you guys have ETFs that you want me to take a look at and tell you, hey, is this one going to be good? I'm happy to do that for you.
Yeah, that would be fantastic. But I'm super happy that you're able to answer all these questions. And as of recent, too, like, I think I've just been putting most of my money in DIA because from what I've seen, it seems to have the most consistent movement, for being a solid position. Like you said, it's definitely the smallest credit I receive of the week. I would say my most successful credits have definitely been SPY and IWM. But as far as not being worried at all, like if you're someone who's worried about your positions, GIA is definitely the one that will make you least worried, I would say, from the rest, from my experience.
Yeah. Yeah. For beginners, I would say SPY, DIA, and then trading a TQQ at like 90, above 92%. So
Mm-hmm.
you can even do that at 92% on here. I mean, obviously, again, not out of date quotes, but 92% for around 67.5 minus 60 10 right there. You're talking about set what 70 now you're talking, well, 60.75 minus 565 on like a 147, so that's the three strike wide.
Mm-hmm.
Yeah, I mean, you're talking about 22 cents there, so about $22 a spread. So that's even possible as well at a really high clip, at a very high clip, meaning a massive amount of runway where you can count these black spaces if you want. That's what I call a clip, these black spaces.
Mm-hmm.
So yeah, that's another suggestion as well. So yeah, well, hey
Fantastic.
guys, this was a really good opportunity. I really like this. We'll definitely keep doing these, probably on a monthly or maybe a bi-weekly basis as 2020 rolls out. But best of luck to everyone trading in 2021. Happy New Year, guys, and let's do this again soon. Great to hear from you, and it was also great to meet you.
Yeah, let's do it again, man. Thanks for doing this.
Of course, have a good one, guys.
Yep. See you guys.